Hello and welcome. So this is last chapter, the chapter 12. It is written 11, but in this current CSC updation, they have moved chapter 11 and 12. So the corporation, we are going to discuss about financing and listing of securities. Now before we start, whether it's a corporation or whether it's government, it requires capital. So corporations require capital to grow, to expand, to do business, right? To for day-to-day activities, for expansion, for R&D, all those things. Government also requires business to develop pipelines or not develop pipelines, or to buy railway carriages to supply the Albertan oil, or at federally to start hydroelectricity plants in Quebec, etc. Now where do they get money? So they get money from investors. So both government and corporations require capital, right? So government as well as corporations raise capital. Now the big difference between corporations and government is government cannot raise equity. So you means government crown corporations can, but the pure government, that is federal, provincial and municipal, cannot raise equity. You cannot buy, I cannot buy stake in the Alberta government, I cannot buy stake in the Canadian government. That's the big difference. But corporations can issue equity. So how do corporations finance for their growth? So they do it by issuing common shares, preferred shares and debt. So common stocks is where they are selling ownership. Preferred stock is they're selling a promise of paying fixed dividends out of profits, and debt is where they're going to pay you interest. Now, whenever they issue capital, that is common stocks, there are four definitions that you have to be comfortable with. One is the authorized capital. So when the company is formed, you have to state how many shares you're going to give. That becomes your authorized capital. You may not issue the entire capital, but you have to state how many number of shares you're willing to give. For example, when I start a company, or I have started two companies in my life, so we had to mention in the charter of the company how many number of shares we are going to issue. Let's say 1 million shares we are going to issue. Whether we issue the entire shares or not, it depends on us, but you have to mention it. Now the second question is, can a company change that? Yes, the company can change that, but it has to it needs shareholders approval to do it. So the maximum number of common or preferred shares which the corporations may issue under the terms of charter is decided when it is incorporated. Usually more shares are authorized than typically issued to the shareholders. Now, out of the authorized share, the amount of shares I have issued throughout my life becomes my issued capital or issued shares. So let's say I had 1 million shares in my company when we started it, and out of that we issued 900,000 shares. 100,000 shares are not issued yet. 900,000 shares we have issued it. So that becomes our issued shares. Now some of these shares we can buy back. So 900,000 we issued, but we bought back 100,000 in the future, in the future time frame. So that 100,000 that we buy back, that is put into a treasury account. That doesn't, you cannot nullify shares. So that goes into a treasury account. So the voting rights are stripped and they go into a treasury account. So number of shares that are available with the public can be lower than the issued shares because of share buyback. So issued share is that part of authorized shares which have been issued by a corporation. A corporation is not required to issue all of its authorized shares. Outstanding shares is what is with public. Out of issued, some shares I buy back. Whatever is left with the public is outstanding shares. So part of the issued shares which remain outstanding in the hands of shareholders of the company. It is often used interchangeably with issued shares, but it's wrong, because issued shares minus treasury stocks equals to outstanding shares. It is also used to determine market cap of the company. Total shares outstanding multiplied by current market price gives the size or market cap of the company. So it's very important. If no redemption or repurchase of shares are made, the number of shares issued will be same as number of share outstanding. But if redemption is made, then you have to deduct it by that amount. Then all outstanding shares are not traded at a given point of time. Some of the outstanding shares are held by company insiders like directors and all, that they don't trade. Some of them are with employees. Some of them will be with institutions that do not trade also, like pension funds and banks and all those things. So whatever shares that are with insiders and are with financial institutions, these are deducted from outstanding shares to get public float. So public float is the amount of shares that are generally traded. So issued shares that are outstanding and available for trading by the public are called as public float. Excludes large block of shares owned by institutions like mutual funds and pension funds that do not trade them. Small float means if a company has extremely small floats, so only limited number of shareholders, then one shareholder can have significant impact on the amount of on the price of the share. So it becomes more volatile. So smaller the float, more is the volatility. Share price can be greatly impacted by large buy and sell orders if you have a small float. If you have a large float, then there is less volatility in share price as the shares are widely held. Now, how does a company issue shares? So there are two ways to do it, either in an agency way or in an underwriting way or as a principal way. So I'm a company. I want to issue my shares to investors. I don't know these investors. So what I do, I approach an investment bank. Investment bank will either work as an agent, so they will take my shares, take commission from me and sell it to investors, or they will work as an underwriter. Underwriter means they will buy those shares first from me, they will add their commission or spread, that is called as a spread, and then they will sell it. For example, they will acquire shares from me at $25, add their commission of $5, and then add their spread of $5, and then sell it to investors at 30. So this is called as underwriting, because they're buying it first from me and then they are selling. So underwriting or financing involves raising debt or equity capital either publicly or privately. So then they can sell it to either public or private. Governments bring new issue of debt to market via competitive tender or fiscal agency process. So generally federal debt comes through competitive tender, and provincial and municipal debt comes from fiscal agency process. What's the difference? Fiscal agency means the yield, then government doesn't issue majorly equity, it is issuing debt. So the yield of the interest rate of the debt, the tenure of the debt in provincial and municipal issues is decided basis on consultation with an investment bank or with a syndicate as it is called. But federal debt is issued in the form of tenders. So they open the tenders and people bid on it, means these institutions bid on it. Whoever bids the least gets those tenders. Corporation bring debt and equity to market via IPO or secondary offering. The Canadian government issues. The competitive tender system is used for most issues by the Canadian government. It is a type of auction. Only, this is important, everyone is not allowed to participate in that auction process. Only government security distributors are eligible to participate. Each government security distributor, or GSD as it is called, is allowed to make two kinds of bid, a non-competitive bid or a competitive bid. So it is exactly like buying shares on limit and buying shares on market. In competitive bid, you have to mention the yield that you are willing to accept. In non-competitive bid, you don't mention a yield. Whatever is the average yield of the auction, you accept that. GST typically includes Schedule 1 and 2 banks, investment dealers, and certain foreign dealers. How it works? Each competitive bid is decided on yield basis. So government gathers bids from different GSDs, and then it will rank them according to the yield. So it's a simple process. First, let's say I'm a government and I am raising 1.25 billion dollars. I am raising 1.25 billion dollars in terms of debt. Now, out of that, 0.25 billion is non-competitive bidding. So first I deduct that. So I have only $1 billion to be given in competitive bidding. So that $1 billion I'll distribute to different dealers based on the yield. The lowest yield gets preference because then I have to pay the least amount of interest there. So I'll distribute these $1 billion according means in different dealers based on what they have approached me for, and the non-competitive bidder gets the average of these yields. So primary dealers can bid up to maximum of 40% of the total amount of bonds being offered. Each bid is accepted in rising order of yield until the full amount of auction is allocated. Non-competitive tenders are allocated by Bank of Canada at the average price of competitive tenders. Provincial issue, new issues of provincial direct and guaranteed bonds. Direct means the province's investments issuing bonds directly. Guaranteed means a provincial corporation, for example Alberta Utilities, is issuing the bonds, but it is guaranteed by the Alberta government. So guaranteed bonds are offered in Canada and are usually sold at the negotiated price through a fiscal agent. Fiscal agent generally is a investment bank who consults with the government on what should be the tenure, is it the right time, and all those things. A provincial government appoints a group, a syndicate of investment dealers and banks to underwrite issues as well as advise and manage the process of issuing securities. Municipal issues, it is likely to be placed with institutional portfolios and pension account. So they are generally not issued to investors, generally majorly to financial institutions, means mutual funds as well as pension accounts. Municipal bonds and debentures require in-depth knowledge of tax generating potential of the local municipal areas as well as industrial base and other demographic information. So generally they are more risky and little bit difficult to analyze. That's why institutions generally invest more in them. Corporate financing, it is always done through an investment bank. A brokerage firm underwriting department negotiates with the company on the type of security, price, interest, or valuation multiple, special features and protective provisions that are needed to market a new issue successfully. So investment bank reviews the company and advises. Reviewing the company is called as due diligence process. Then it advises on what should be the size of issue, what type of security, debt or equity it should be offered, is the timing good, what should be the timing of issue, whether it should be a public placement or private placement, so selling to the general public or selling to only few participants. Developing the prospectus. So whenever a company issues security, it has to file in prospectus with a provincial body for its approval. Now, earlier, where you had to file in prospectus with all the provinces where you were issuing securities, but then we developed the passport system. In passport system, you just file a prospectus with one province, then you get a receipt from it, and then you show this receipt in other provinces and you are good to go. So no need to file it with each province now. So prospectus, there are two forms of prospectus: the red herring prospectus or the full prospectus, and there is short form prospectus. So if you're a new company, you are not filing your financial statements before with the provinces, then you go for the full prospectus. But if you're an established company, you have already been filing those statements, then you can go for short form prospectus. Then they also help in setting the offering price and they do some market support. So we'll discuss it in the future slides. Dealership relationship is either as agent, so acts on behalf of buyer or seller, earns commission, does not assume the ownership, or it is in principal or the underwriter, earns spread on offering price, ownership of issue before being sold. Methods of offering, it's either private placements, so it is placed to one or the few large institutional investors. Typically no formal prospectus is required because you're only giving it to limited number of people. Public offering offers to issue securities to public, act as a principal or agent, but you have to file prospectus. Short form or red hearing depends on whether you are means connected with the provincial government before, whether you have been filing your statements before, but irrespective of that you have to file a prospectus. Underwriting forms, a bought deal. Normally, one dealer buys the entire issue, then it is sold either as a private investment or as a public offering using a short form prospectus. Lower spread between dealer's cost and final selling price, which tends to be well below the traditional financing cost, but you are assuming the entire risk of position, so you act as a principal. Conventional underwriting is agency transaction, attempts to sell as much as possible, but there is no guarantee. Then other forms of underwriting, lead underwriter or financing group has contact with the issuer, advises the issuer on the new issue details, participates or helps in document preparation, gets clearances with security commission. Then you have a syndicate. Lead dealer does the underwriting and shares the risk with several dealers. So if a issue is very big, then it becomes difficult for a single entity to underwrite the entire issue, to buy the entire issue. So they come in as a group, large group of dealers, including a lead underwriter. They are liable for their individual participation. So generally, issuing company sells it at a price, the financing group buys it at a price, then sells it to the associate at some different price. So the difference between buy price and sell price is their spread. Now, when you file for new issue or a continuing issue, now whenever you are means getting a new issue or you're raising capital, you have to have a prospectus. So prospectus is a disclosure document. So this provides information about provides information document that provides investor with a provincially set minimum amount of information. It provides detailed description of security offered, issuing company history, operation management, risk factor and financial statement. The principle is there should be full, that is you have to disclose everything, it should be true, and it should be in simple language, that it should be plain. Disclosure of all material facts related to the securities being offered. Now, there are two forms of prospectus. If you are new, you have to file the full form, that is preliminary prospectus, also called as red herring prospectus. If you are old, means if you have already been in the system, then you use short form. So red herring prospectus, it is submitted to the provincial security administrators for review. Issuing company then has 90 days to prepare and receive approval for final prospectus, the waiting period. It is called a red herring prospectus. It excludes the final price, so final price is not there. Can be used to solicitate expression, but you cannot take money until and unless you are approved. Short form, the biggest advantage is there is no waiting period. So you avoid the waiting period when you file a short form prospectus. It is used by senior reporting issuers who make continuous disclosures already. Excludes much of the information found in full prospectus, focuses on information of security being off distributed. Key, shortens the time period needed to bring an issue to a market. Waiting period is lesser. A company can use short form prospectus if it files electronically using SEDAR. It is reporting issuer in at least one of the Canadian jurisdiction. It is up to date in filing its reporting issuer jurisdiction. Has filed current annual financial statements and current AIF in at least one of the Canadian provinces in which it is a reporting issuer. Has not ceased operation. Its principal assets are not cash or cash equivalent. Has equity securities listed or quoted for trading. Then, apart from getting the securities listed, investment dealers also help in aftermarket stabilization activities. What is it? The issue is not now trading in secondary market. It is an arrangement whereby the lead dealer steps in to support the price of an issue. So method used are over allotment or green shoe option. It means when the security gets listed, dealers have an option of issuing additional securities than what they were listed. So they can increase the supply. If there is lot of demand and share prices are means the share prices on listing goes upwards a lot, they can encash on it and issue additional shares. Generally it is 15%. Green shoe means you can issue additional shares, you can increase the supply by uh, issuing more shares, generally 15%. Then you can penalize dealers for selling group who flip shares. So certain players who are flipping shares on listing, you can penalize them. So reduces future allocations through a penalty bid, and they have to repay the commission. So people don't prefer means a company does not prefer dealers flipping their shares when when the shares are listed, because it increases the supply a lot. So you can avoid doing that by having a condition that if you flip shares, you will be allocated less in future IPOs, as well as you have to pay the commissions back. Post tabulation bid, so this is increasing the demand, so they can have a support price. So post stabilizing bid to purchase share at a price not exceeding the issue. So you can increase the supply, you can penalize for people who are flipping, or you can increase the demand by having a support price. There are other methods of distributing securities. One is junior company distribution, generally used by oil exploration companies and by mining companies. It is also called as risk capital. It's a zero sum game. You give money to a company. If you find oil, if you find minerals, you make money, otherwise you lose everything. Option of treasury shares and X-road shares. So this is also one possibility. So sometimes you have to deposit your shares, and means if I'm a company and I'm not able to find an investment banker who is comfortable in buying or underwriting my shares, so I can give him an additional carrot whereby he gets certain options. Okay. Capital pool company program, it is like a mutual fund for small firms. It is done by TSX Venture. So they open a mutual fund, investor invest, and then this mutual fund is used to invest in companies that are at very early stage. NEX, so unlisted securities are means traded in on NEX platform. So if your security is delisted and you still want to sell it, you can sell it through NEX. Then there are other ways, new ways like crowdfunding or Kickstarter campaign that you can raise money with. Now there are certain advantages of listing. So advantages of listing is you get prestige and goodwill. It establishes the market value. You constantly get what is the size of the company. Visibility increases. There is more information available for investors. So it is beneficial for investors for a company to get listed. It facilitates valuation for tax purpose, especially the estate purpose. There are disadvantages of listing also. There are additional controls on management, so less flexibility. You need to keep market participants informed, so more disclosures. Market indifference, so low trading volume in a listed security is a matter of public record. So share price going down, volume going down, it means it is a matter of public record now. Additional disclosures are required, additional costs to the company. Now, sometimes exchanges stop the issues from trading. So they do certain temporary trade interruptions. So delayed opening. So if there is heavy influx of buy and sell order, so they may delay the opening. For example, market is opening at 8 o'clock, then your company may open for trading at 9 o'clock once the market stabilizes. Sometimes they do it if there are a lot of buy and sell orders, large buy and sell orders. Halt in trading, can occur at any time to allow significant news to be reported. For example, if I am a company and I'm undergoing some merger and I want to disclose that information, so I have to tell the exchange, then the exchange stops trading, then I disclose my information, then the trading is started. Suspension in trading: financial condition does not meet the listing requirement of the exchange, so they are suspended. And delist suspension is temporary, delisting is permanent. So delisting can occur because of security no longer exists, the company is bankrupt, the public float has become too small, or the failure of company to comply with listing agreement. So this is it, chapter 12 done. So CSC level 1 ends here. Thank you for your participation. All the best if you're giving your exams.